I'm Greg Hunter. Welcome to USAWatchdog.com. With us, the founder of Gold Money, James Turk. James Turk, thank you for joining us today from Great Britain.
Thanks, Greg. It's a pleasure to be with you.
A little more to your resume. You're obviously expert on precious metals, expert on global economies and finance, and I really appreciate having you on. In the pre-interview, I was saying, wow, we live in interesting times, don't we? We live in bizarro world interesting times, don't we? Have you ever seen this, what's going on right now in your life?
No, absolutely not. I mean, there's so many crazy things going on. People around the world are paying governments to take their money with negative interest rates. I mean, who would have thought that would have ever been possible? It really is crazy, Greg.
I want to move on to a story out about El Arian, former Pinco great. He's still great, smart guy. He says he's mostly in cash. And what's the idea behind that? I mean, that's a bearish, very bearish move to be mostly in cash. Give us your analysis on why he's doing that.
Yeah, when you're talking about cash, let's look at it from a big picture point of view. You're really talking about being liquid. And there are different types of liquidity. You can hold any of a number of national currencies and be liquid. You can also hold gold and silver and be liquid, because gold and silver trade 24/7, just like national currencies trade 24/7. So the question is, which one is the one that makes the most sense at this moment in time? Now, you can basically play the different currencies, which bob up and down against each other, depending on what one country's central bank is doing versus another country's central bank. Or you can own physical gold and physical silver and know that you don't have counterparty risk and that your purchasing power is going to be preserved over long periods of time. So, yeah, liquidity makes sense at this moment in time, given all of the uncertainty in the world, and given the fact that there are a lot of assets out there that are very overvalued. But if you look at the currencies or the different types of liquidities themselves, the national currencies are overvalued relative to undervalued gold and silver. So I think holding liquidity makes sense, but I wouldn't be in dollars or euros or any of those currencies. I'd be holding gold and silver, physical gold, physical silver.
I was watching CNBC the other day, and about 80% of the panel was, I think where the trade is to buy gold, near term, and whatever. And one guy says, well, I'm not buying it because it might be a trade, but the overarching fundamentals of gold are gonna go down. That it's basically not found a bottom yet, and I'd stay away from it. What do you say to people who say that, and what's your counter argument?
Yeah, the fundamentals of gold are that if a currency is being debased by central bank's action, the gold price will eventually go up. It will go up because of the force of the market. It will go up because people understand that gold is undervalued relative to national currencies, or it will go up because they understand that gold doesn't have counterparty risk. When you have a tangible asset, the value of that asset is not dependent on someone's promise. So the history of gold over the past century has been it will continue rising because central banks have been debasing currency. And in fact, gold has risen from $20.67 per ounce 100 years ago, to approximately $1,200 an ounce today. And to me, gold still looks cheap and undervalued, so I think it's going to continue to go higher because central banks continue to debase the currency. It's really as simple as that. There's a related point, Greg, that I think is very important. People say that if you own gold, you're going to get wealthy, or wealth is going to be created. That really doesn't happen. If you own a bunch of ounces, or if you own a stack of $100 bills, they're basically sterile assets. They're not really investments. They're money. They're means of purchasing power for interacting in the marketplace with other people. So when the price of gold goes up, what's happening is that you're taking the purchasing power away from people who are holding national currencies and getting that purchasing power because you own gold, but there's no wealth being created. And I think that's an important point to make. Look at gold for what it is. It's money. It's not an investment. It's a sterile asset that does not generate cash flow. It doesn't pay dividends. It's money. And that's, I think, an important point everybody must realize when they're looking at gold or they're looking at silver.
Well, you make that point every day with goldmoney.com. I mean, that's your idea for your website was gold, money, gold is money, goldmoney.com.
Yeah, historically it used to be that not only was it money in terms of doing all the things that money does, preserving purchasing power, enabling economic calculation to measure the prices of goods and services and the value of other goods and services, but it also used to circulate as currency. And my view has been that even though governments have put impediments in the way to stop gold from circulating as currency, it will circulate as currency once again in a modern form, online currency, not necessarily coins or things of that nature, and definitely not paper certificates, but in some kind of online form. And I think the technology is going to make that happen sooner rather than later.
Do you think the dollar blows up this year? I mean, we have the AIIB. That's no accident. They call it the Asia Infrastructure Investment Bank, but they might as well call it competing world reserve currency.
Yeah,
I mean, really. Forget enough of the Asian infrastructure investment, so they don't make anybody mad. Aren't they really getting? Or why do they need to have infrastructure in the UK and in France and in Germany and in America and in Central America and in South America? I mean, what do they need infrastructure all over the world? They're going to build highways all over the world, or are they going to have a reserve currency? What say you?
Yeah, China is striving for stature, it's striving for dominance, and this is to be expected. It's now, if not the largest, the second largest economy in the world today. And the prospects for China are going to be, continued growth because that's what they're basically encouraging in terms of, government policy. Obviously, there are going to be hiccups along the way, just like in any other country there are hiccups along the way, but China is a player, and it's going to remain a dominant player for a long period of time. So because they weren't able to bring about changes in the World Bank that they sought, and there have been some question as to what kind of role China would play in a number of organizations that were created mainly by the United States after the Second World War, China said, well, I'm going to go create my own sandbox and play over here because you're not letting me play in your sandbox. And I think that we're going to see more of this in the years ahead. China exerting its muscle economically, politically, and hopefully not militarily, but they have been building their armed forces. The other thing that's sort of a little bit frightening about this is that you've got China, because of what's happening, moving closer and closer to Russia. China's got the money, Russia's got the resources. The two of them together are going to be a very, very powerful force that has to be reckoned with.
Do you think that the AIIB, the Asia Infrastructure Investment Bank, let's just call it the AIIB, do you think that they could be open this fall? Some people think that it could at least lower the value of the U.S. dollar this fall, and maybe even knock it out of the box eventually. Do you think that the dollar could come under real pressure this fall? Do you think we could have a reckoning this fall? A lot of people are pointing towards this fall for a variety of levels, for a variety of reasons, I should say.
Yeah, I think that's a time frame that we should be looking for, and there are a couple of reasons for this. Every 5 years, the International Monetary Fund recalculates the special drawing right, the SDR. And so far, the Chinese yuan has not quite clear over the past 5 years, particularly, that they want to be included in the SDR when the next reweighting comes. And that reweighting and recalculation is scheduled for September, October. So it's quite possible that if China doesn't come away from that IMF meeting with what it thinks it deserves, given the size of its economy, the size of its reserves, the industriousness of its people, it may further and further move away from Western institutions and create Asian institutions like the AIIB and bring those to fruition more quickly than otherwise would be the case. So I agree with that September, October, November timeframe. I think that's going to be critically important in this year. And if the wrong moves are made by the U.S. government, I think the dollar, could fall substantially. Remember, Greg, that the dollar has only risen here because people around the world perceive it as the best option of a lot of poor choices. In other words, people are moving out of the euro and they're moving out of other weak currencies and an emotional knee-jerk reaction into the dollar. They're not moving into the dollar because of any fundamental strengths. The problems in the U.S. are still quite severe, particularly the debt problem, government spending out of control, and the issues that we've talked before in the past. So, the dollar has come up a long way over the past 6 months, but things tend to rise and they tend to fall, and I wouldn't be surprised if we have a big drop in the dollar as we move toward the end of the year, and also a rise in the gold and silver price as well.
Could we have a stampede out of the dollar? I mean, just as fast as people moved into it, people could move even faster out of it?
That's
and where would
really,
they go?
Yeah, that's really an important question. It's a very good question. I think a stampede out of the dollar has already happened to a certain extent. But let's say a stampede out of fiat currencies has happened. That's why you're seeing record real estate prices and craziness in places like here in London or in Singapore. It's why you're seeing antique collectible cars soaring in prices. Why collectible artwork is soaring in prices. Money is a function of supply, and it's also a function of demand, just like any other good and service. So your question is a good one, because if for some reason there was some event that would cause people to move out of the dollar and look for other alternatives, it could happen very, very quickly. And naturally and historically, when people move out of a paper currency, they move into tangible assets. They move into farmland, timberland, equities of companies that own tangible assets, and of course they also move into physical gold and silver. And I mean, we even know that to be true just from recent history. Look what happened in Zimbabwe. When that currency collapsed, people moved into gold and silver and real things. It's happening now in Venezuela. The shelves in supermarkets are being closed because that currency is collapsing, and people would rather have a box of soap detergent than hold the currency, because they know the currency isn't going to be worth as much tomorrow as it is today. So when this collapse in the demand for a currency occurs, you get the flight out of the currency, and that spells doom for the currency, and the currency ends up in the fiat currency graveyard, along with the other 100 fiat currencies that have died since the end of the Second World War.
I know people ask you this, but it's been a rough since, I don't know, 2011, 3 or 4 years in gold and silver. Is it a bottom here? I mean, people who are holding gold and silver, I want you to address both, if you will. Do we look like we are having a bottoming right here in your estimation? I mean, you study this stuff all the time. You built a life, at goldmoney.com. Do you think we're bottoming right here in precious metals, gold and silver? And
yes. Yeah, I do. But, in all fairness, I also thought that was last year, too. And, it's been a long year. We're just moving basically sideways within this range. But that's what turns the market eventually. The market doesn't turn like a speedboat. It turns like a battleship. It takes a long time for it to turn around and go 180 degrees in the other direction. And we've got enough work technically under the market for it to be a turning point. But it all comes down to fundamentals at the end of the day, Greg. And fundamentally, gold and silver are cheap. And the thing that will drive it is continued monetary illness with the various fiat currencies around the world. Whether it's banking problems, inflation, deflation, central bank mismanagement, whatever those problems happen to be, the safe alternative is the precious metals. That's what history tells us.
Do you think that we're going to have a moment where the Chinese, who have been importing, for years, many tons, hundreds of tons a year, do you think we're going to have a moment where, the gold price, the Chinese are going to say, you know what, we think this is too low. We're coming out on the market. Here's how many tons we have, and it won't be 1,000. It won't be 1,000 tons. It'll be 10,000 tons. A lot of people say it might be 20,000 tons. Who knows? That's way more than what they're publicly stating. Do you think the Chinese could be a big factor in driving the gold price up? You think they're going to say, hey, we need our money to be more valuable because we'd like to be a bigger part of the SDR or whatever, or the AIIB? I mean, I'm just speculating here. Do you think the Chinese could be play a critical role in driving the price of gold up on purpose?
Well, whether it's on purpose or not, it's hard to say. But for the last decade, they have been a big factor in gold because they've been accumulating large amounts of physical metal. And while we talk about gold generically, the reality is there are two different types of gold. There's physical gold, the tangible asset, and there's paper gold, which is just a financial asset with counterparty risk and the promise to pay at some future date. Now, what the Chinese have been doing is they've been accumulating huge amounts of physical gold year after year after year, both at the government level as well as in the private sector level. And that's what you really want to accumulate, because at the end of the day, or in the final analysis, it's the physical market that drives the overall gold price. From time to time, the physical market and the paper market intersect with one another, but it's the physical market that ultimately drives it, for the simple logic that a gold coin in hand is worth more than two gold coins in the bush, as they say, using coins instead of birds. From the point of view that it's real, it's substantial, and history has proven, that gold is money, and that's likely to remain for the foreseeable future. The Chinese understand it. I don't think they're going to do anything to purposely disrupt the system as it exists today, because the way the system is working, it's to the Chinese advantage. They're accumulating huge reserves, and they're going around the world spending those reserves, buying up resources everywhere they can. So they're going to continue to play the system to their advantage, but when the system finally collapses because of its own weight, the Chinese will be able to rebuild another system because of the gold that they have. It may not be a gold-backed yuan, the Chinese currency, but you need to have that gold in order to have credibility that the monetary system you create is going to be durable.
So they're playing the system. In other words, they're getting all the gold they can at $1,200 an ounce, when really it ought to be $2,000 or $2,500. Is that what you're saying?
Yeah, exactly. But it's not just gold; it's everything. Under the classical gold standard, sovereign wealth funds were not possible, because what would happen if too much money flowed into a country, the gold would flow out, and that would cause the contraction in the economy, and there would be a balance between flows of capital around the world. What's happening with today is there is no settlement, there is no payment. We import refrigerators and whatnot from China and give them IOUs in the United States. China then takes those IOUs and buys real resources. There's these huge sovereign wealth funds, these huge foreign reserves that have accumulated. Basically, you have to look at it from both sides of the balance sheet. It's an asset on the balance sheet of the Chinese government, but it's a liability of somebody. Those reserves are owed by somebody. And at the end of the day, those debts have to be settled. They have to be paid. And they're either going to be paid by the borrower, which is the United States and all the other governments that are running trade deficits, or they're going to be defaulted upon, in which case China pays. When you see defaults like that, that can often lead to wars. I hate to say it, but there's a lot of global tensions out there in the world today, and I think there are a lot of places in the world where real fighting wars can pick up very easily, in addition to the fighting wars that are already going on.
Do you think we're going to be getting a big old war? Captain Austin Fitz says, before there's a collapse, we'll have a war. What say you?
That's possible. I very much respect Catherine's opinion. I've known her for quite some time, and I regard her work highly and her insight highly. And, that's often the case, because politicians, rather than blaming themselves for a screwed up economy, blame somebody else. And that blaming somebody else can often lead to war.
Let's talk about, you made a point about, debts, ultimately either have to be paid or they won't. And a lot of people are focusing on Greece right now, whether they pay in a few days or whatever. This 500 million euros or $500 million payment that they have to pay the ECB, and they say they're going to pay it, and some people say they're not, and whatever. But really, the bigger picture is Greece can't pay its debt. Whether they make this payment or not isn't really the salient point, right? I mean, ultimately, they're going to crash. They're going to say, "Oops, we're done." And then, can you talk about that a little bit, and also them cozying up to Russia? It appears that Russia is going to offer them maybe some sort of bailout, some sort of deal, and they're a NATO country. Can you just talk about Greece and then fan out from there? Because it's not just Greece that's broke. I mean, a lot of people think that French banks are broke, that the Italian banks are broke, that the Spanish banks are broke, that the U.S. bank is broke, that according to Lawrence Kolikoff, they said, we're broke. So fan out from Greece and tell us about what you see with the global economic scenario we're facing right now.
Okay. First, with regard to the Russian thing, the Greek prime minister is in Russia today, so we'll find out a little bit later what, if anything, has transpired in that meeting. But there are cultural, religious, historical ties between Greece and Russia. So it is quite logical that he's looking for friends. The prime minister is looking for friends all around the world, and it seems logical that he would look at Russia as a possible source, maybe discounted oil prices or discounted energy prices as a way to help the Greek economy. But, what we should do when we're looking at a country like Greece is, look at what's happened before so that we can see how things have transpired. And I think the best case is maybe Iceland. What happened in Iceland is everybody said, oh, they're going to pay their debts. They're going to pay their debts, just like they're saying with Greece. Even though if you looked at it mathematically, there's just no way that Iceland had the resources to repay this huge mountain of debts that they had. The banking system in Iceland was essentially insolvent. So when they finally decided not to pay, the currency collapsed in Iceland and the economy was devastated. It's the same thing in Greece. There's no way that Greece is going to repay the $350 billion of debt, euros of debt that it owes. It just doesn't have the financial capacity or the ability to do that. So all of the ECB, the EU, and the IMF have been trying to do is, the term is called extend and pretend. If you keep the ball in the air, people will think, okay, well, it's going to be solved eventually and that, I'll play a game. But the reality is that ball eventually crashes to the ground simply because of mathematics. And what I'm talking here, of course, about is cash flow and the ability to generate the wealth to repay and service those debts. And it's not just Greece, as you clearly point out. There are countries all around the world, including the United States, that have such a huge debt burden that these debts are never going to be repaid. I mean, the U.S. government's debt now is over $18 trillion. The only reason why it hasn't hit the wall in the United States and in Western Europe is because interest rates are near zero. If governments were paying a fair rate of interest on their debt, we would already be in a hyperinflationary spiral because there's no way that they would be able to cover the interest payments. The U.S. government debt is about $18 trillion. Just a 1% rise in interest rates means $180 billion. If it was paying, 5 or 6%, which is normal interest rate one would expect on a government paper, that's an extra $1 trillion a year. That's 33% of the government's revenue. If it's not going to cut back in other areas in order to pay that interest, that would cause the government to borrow more. If it borrows more, interest rates are going to go up, causing an even bigger interest rate burden, and eventually that's how the currency collapses. So the governments have bought time by bringing interest rates down to zero, but they're not solving the underlying problem. There's too much debt. A lot of this debt is going to be reneged upon, and as a consequence, we as individuals have to recognize that that's a real possibility, and that we need to do is avoid counterparty risk, focus on tangible assets of all sorts, real things that after the collapse, those real things are going to be there. The farms are still going to be there, the buildings are still going to be there, the factories are still going to be there, the gold and silver is still going to be there. But a lot of this paper that's floating around the world is going to disappear. That's what happened in the Great Depression.
Didn't they add to the debt? Didn't they make it worse? I mean, the Bank of International Settlements, just talking about derivatives, I mean, we went from $700 trillion in derivatives to, and they admitted this, a quadrillion, 1,000 trillion. That's the official number. A lot of people say it's much higher, twice as high, 2.5 times higher. But anyway, it's a big number. And so what you're saying is that that not just Greece. Greece is the canary in the coal mine. There are big old turkeys all over Europe, all over the world that have a lot of debt that needs to be washed out. And what's going to be the trigger point for people to finally say, this is never going to, okay, let's get real here. It's never going to be paid. And we're going to wash this out. I mean, what's going to be the trigger point for that? And is that why the Chinese are starting their own clearing system, their own, international bank for everybody to use?
Yeah. That's the million-dollar question, Greg, that everybody's trying to figure out. What's going to be the trigger that brings it all down? And, you're getting at, what can we predict the future? And sadly, nobody has that capacity to predict the future. The best we can do is prepare for the future, and that's what China is doing. That's why China is creating a parallel payment system to SWIFT, which is the one that's been dominated by the U.S. Essentially under the influence of the U.S. government and U.S. banks. That's why China's created this AIIB, and that's why China's accumulating gold. So, as we prepare for the future, we should be thinking in the same lines that China is. Buy gold, buy resources, minimize to the extent you possibly can the counterparty risk that comes from financial assets, because we don't know what the trigger point is, but We know from history, we know from mathematics, looking at the cash flow of all of this debt around the world, that it cannot be serviced, and there is going to be some kind of a problem. Just like 2008. For everybody who remembers 2008, we've got another one of those coming. And if you go back and look, there have been a lot of little things like that throughout history because of the way banking is practiced. Banks make loans that are risky and don't get repaid. That impairs bank capital and bank solvency, and then you have a depositor run like is going on in Greece at the moment, and that ultimately results in an economic collapse. So yeah, there will be another 2008 coming. Unfortunately, I just don't know what that trigger is going to be. So the best we can do is to prepare for it.
Greece could be one of those triggers, and you said that the ECB ultimately will steal their money. Just finish up with that.
Yeah, the ECB has credit exposure to Greece. It's probably now about 105 billion euros. There's only about 130 billion euros left in the Greek banking system. So those two amounts are converging. Deposits are shrinking as the run continues, and Greek exposure of the ECB has been increasing as they've been funding the Greek banks to provide them with the euros to pay to people who are taking their money and running with it. If we look what happened in Cyprus, when those two amounts converged in Cyprus, the ECB pulled the plug, and as a consequence, the Cyprus banks were nationalized, and the Cypriot economy, fell off the edge of the cliff. We're very, very close to that happening in Greece. Next week is critical because there are two big debt repayments that Greece has to make, and they don't apparently have the cash. So unless there's some heaven-sent money from somewhere, I think next week you're going to see a lot of turmoil.
Well, I want to close with this with one thing, and people have been asking me about, the $1 million question. There's a guy stopped me the other day who reads the site, USA Watchdog, here locally, and says, no kidding, he says, well, what about the update on the collapse? And I said, and I want you to tell me if this is true, because you're one of the experts I talked to. I said, the experts have two things that they all agree on. Now, whether inflation, deflation, they don't agree on that. They don't agree on the timing. Nobody knows. But two things they all agree on. A, this is unsustainable globally, not just for America, globally. What's happening is unsustainable. And B, we're going to have a crash. What do you say about that statement? Are those two things that you would agree on? Do you think other people agree on? We're going to have a crash because it's not sustainable.
Yeah, it's definitely not sustainable. And when something like that happens, it ends, and it ends with some kind of catastrophe. Now, I'd like to define this word crash because it means different things to different people. When you say crash to me, that means an economic collapse, like the Great Depression. That's what I think will happen. Other people define that crash to mean a stock market crash. I don't think that's going to happen. I think as the currency crashes, which is what my expectation is, the stock market will go up. And the reason is that if you own shares in companies that own tangible assets, like Exxon Oil or a mining company or an agribusiness company, those companies are going to continue to produce wealth because people are going to want the products that those companies produce. So the shares will go up in terms of the currency, just like they did in Zimbabwe in 5 years ago or 6 years ago when it hyperinflated. It was the best performing stock market in the world, measured in terms of its local currency because the currency wasn't worth anything. So yeah, it's unsustainable, and there will be a economic collapse. That's the crash that I think everybody has to prepare for.
Of course, the other thing that when you're buying stocks, you got to worry about the MF Global moment. We hypothecated we rehypothecated. Oh, you thought you owned that? Yeah, no, that wasn't really in your name. I mean, don't you have to worry about that, about the brokerage going under? You better have a very strong brokerage, unleveraged and unexposed to derivatives.
Yeah, that's a very good point. I'm not a stock expert, but I know that when you own stocks, you want to own stocks that are paid for in cash, registered in your name, and you own the certificates ideally. But it's very hard to get certificates to stay because the system is not geared anymore to having something physical like certificates. It's geared to having things done digitally, and that's a real risk. So you have to, again, that's why, stocks, you have financial assets and you have tangible assets. Stocks are sort of in the middle. I call them a near tangible. There are a lot of issues that relate to equities, the shares of companies, that you have to look at before you make the decision to have those in your portfolio, including, the management of the company, the company's balance sheet, and, all the other things that come with investing in equity of a company.
Last question. If you were going to predict something, let's say we're in December of 2015, and you're looking back at the year. How would you sum up the year? And in other words, I'm getting you to try to give me a prediction by saying, what do you think is going to happen the rest of the year? If you were going to sum up 2015, what do you think? What do you think it would be? How do you think you would sum it up? What do you think? Where do you think we're going to be at the end of 2015?
I think there's a very good likelihood you're going to see a 2008 situation this year. What the trigger will be, I don't know. But there's so many trends coming together at this moment that you have to be thinking in terms of another 2008. And as for the precious metal prices this year, in 2008 that was a liquidity crisis. People sold what they could in order to get liquid, and they threw out the baby with the bathwater. So gold and silver got sold, temporarily went down, and then came back right away, and ultimately moved to new highs. I don't think you're going to see much gold and silver selling this year if we do get a 2008 crisis, because it's more likely to be a fear event rather than a liquidity event. The demand for gold and silver as a safe haven will outweigh those people who want to sell gold and silver for the liquidity. So that's what I see for the rest of the year, and I wish I could be more optimistic, but let's look beyond that, because that's where the optimism comes in. I am a very optimistic person. And, we humankind continue to move forward, but we don't do it in a straight line. We hit the wall and come back the other way and hit the wall again. And we keep, moving forward in this direction. But it's, there are hiccups along the way, or occasionally we step on a mine. And I think we're going to step on a mine before the end of this year. But a few years' time, I think there's definite reason to be optimism because of all the new technologies that are coming on stream that improve people's standards of living.
James Turk, thank you for joining us today on USAWatchdog.com. Always interesting, always insightful. You're one of our favorite guests. You always get a bunch of really positive comments. James Turk, thank you for joining us today.
Thank you, Greg. It's always great to be with you.